$49. That's the gap right now between what silver costs in Shanghai and what the price ticker on your screen is telling you it costs in the West. And I want you to sit with that for just a second, because what that number means, if you actually understand it, changes everything you think you know about how commodity markets work. Not theoretically, not someday, right now. Today, February 19th, 2026, the Shanghai Gold Exchange is pricing physical silver at roughly $127 an ounce. The COMEX futures screen in New York is showing you 78. Same metal, same atomic weight, same purity, $49 gap. That gap should not exist, and the fact that it does, and that it's growing, not shrinking, tells you something is broken at the foundation of how silver is priced globally. By the end of this video, you're going to understand exactly what broke, who benefited, what it means for the price going forward, and what you should actually be paying attention to right now. So stay with me, because this is one of those moments in markets where the signal is so loud that the only question is whether you're listening. Let me give you the context first, because the $49 gap didn't appear out of thin air. It's the result of a chain of events that's been building for years, and it exploded into full view over the last 3 weeks. Here's the timeline. Silver began 2025 sitting right around $30 an ounce. Quietly, steadily, it climbed. By late December, it broke $83 for the first time in years. Then January 2026 happened, and it was unlike anything the silver market had seen in 4.5 decades. Silver hit $121.67 an ounce on January 29th, 2026, a new all-time nominal high, besting the 1980 Hunt Brothers record, a 305% gain from January 2025 to January 2026, the largest annual gain since 1979. Then, in less than 30 hours, it crashed. CME Group raised margin requirements on COMEX silver futures to 15% on January 30th, and the mechanical liquidation that followed was brutal. Silver fell 31.4% in a single day, the largest single-day decline in precious metals since 1980. By February 5th, it was trading at $77.25, a $13 drop in one session, 40% erased from the peak in under 2 weeks. The U.S. Treasury Secretary, Scott Bessent, went on record attributing the extreme volatility to Chinese traders. Now, that's a statement worth examining very carefully, because here's where the story gets interesting. While Western paper markets were swinging violently, up 300%, crash 40%, rinse and repeat, the physical silver market in Shanghai was telling a completely different story. According to data from the Shanghai Gold Exchange's AG-T+D contract, which, unlike COMEX, requires actual physical delivery, prices in Shanghai were not crashing at the same speed. When New York's paper price collapsed 30% on January 30th, the Shanghai physical premium over COMEX exploded to plus 29%, a $22.98 premium in a single session. Think about what that means. The moment CME used margin hikes to force Western paper traders to liquidate, Shanghai physical buyers stepped in and said, "We'll pay whatever we have to pay to get the real metal." That's not speculation. That's documented price data published by metalcharts.org on February 2nd, 2026. The gap you're seeing right now, roughly $49, is the legacy of that event. Western paper prices recovered somewhat. Physical prices in Shanghai never really came down. 2 markets, 1 metal, completely different conclusions about what it's worth. Now, before I go further, quick message for those watching who haven't subscribed yet. My analytics show roughly 3 out of 4 people watching this right now are not subscribed. If this kind of data-driven analysis is helping you cut through the noise on silver, hit that subscribe button. It helps me, and it tells the algorithm this content is worth showing to more people who need to see it. All right, back to the gap, because I need to show you why it's not closing and why that matters enormously. In normal commodity markets, as in any functioning, efficient market, a price gap this large gets arbitraged away almost immediately. Here's how it should work. Traders buy silver cheap in New York, ship it to Shanghai, sell it at the higher price, pocket the spread, and repeat until the gap closes. Simple. Profitable. It should happen fast. The spread on silver right now, at its peak hitting nearly $49, represents a profit opportunity that dwarfs the cost of shipping, insurance, certification, and every other friction you can imagine. Freight for a 1,000-ounce silver bar costs maybe $1 to $2 an ounce. Even if you triple that estimate for all costs, you're still looking at a 40+ profit per ounce sitting on the table. So why isn't the arbitrage working? That question is the most important question in the silver market right now. And the answer is 2 words: physical scarcity. When traders try to pull real deliverable silver out of COMEX to ship it east, they're discovering there isn't enough there to move. COMEX registered silver inventory, meaning metal immediately eligible for delivery, has shrunk by roughly 75% since 2020. As of February 2026, registered stocks hover around 82 million ounces. Sounds like a lot until you look at the other side of the ledger. Open interest in the March 2026 COMEX contract sits between 85,000 and 91,000 contracts, representing theoretical delivery obligations of 425 to 455 million ounces. You don't need a PhD in math to see the problem. The exchange has promised delivery on 5 times more silver than it has available to deliver. And here's what makes this truly alarming. In just 1 week in January 2026, over 33 million ounces of silver were physically withdrawn from COMEX for delivery. That's 26% of registered inventory, gone in 7 days. Not paper transferred, not account entries swapped, physical metal loaded out of vaults, shipped east, gone. When you see 26% of the immediately deliverable supply of the world's primary silver futures exchange disappear in a single week, you are no longer looking at a normal market. You are looking at a market under existential stress. The analysts at TechFlow put it bluntly in their report. March 2026 may mark the funeral of COMEX. That's not a fringe blog. That's veteran commodity analysts looking at the delivery math and concluding the exchange may not be able to honor its obligations. I'm not here to tell you COMEX collapses. I don't know that, and neither does anyone else. What I am telling you is that the numbers are documented, they're verifiable on CME's own data feeds, and they point to a fracture between the paper price and the physical reality that has never been this wide in modern history. Now let me walk you through the structural forces that got us here, because this isn't random. 3 forces converged simultaneously, and each one would have been significant on its own. Together, they created the scenario we're watching unfold right now. Force number 1 is 5 consecutive years of supply deficit. According to industry data, the global silver market has run in deficit every single year since 2021. The cumulative shortfall from 2021 through 2025 totals roughly 820 million ounces, nearly the equivalent of an entire year of global mine production, vanished. Mine supply globally sits around 810 million ounces per year. Recycling adds about 180 to 190 million ounces. Total supply is roughly 990 to 1,000 million ounces annually. But demand, driven by solar panels, electric vehicles, 5G infrastructure, AI hardware, and medical devices, has been running above that number for 5 straight years. And here's the brutal truth about industrial silver demand. It's inelastic. When an EV manufacturer needs silver for their circuit assemblies, they don't say, "We'll wait until it's cheaper." They buy what they need. When a solar panel fabricator needs silver paste for photovoltaic cells, price is secondary to availability. You either have the silver or you don't make the panel. So 5 years of deficit, cumulative drain of 820 million ounces from above-ground stocks, and a 2026 annual deficit projected by analysts to reach 200 million ounces. That's force number 1. Force number 2 is China's export controls, and this one is a geopolitical earthquake disguised as a regulatory filing. On January 1st, 2026, China's Ministry of Commerce, MOFCOM, implemented a new licensing framework for silver exports, not a ban, something in some ways more disruptive than a ban. Under the new rules, only 44 specifically approved companies are legally authorized to export silver out of China. You must produce at least 80 tons of silver annually to even qualify. You must maintain $30 million in credit lines. The system effectively excludes every small and mid-sized refiner and exporter in China from the international market. And why does that matter? Because China controls somewhere between 60 and 70% of the world's fresh mined and refined silver output. The state-run Securities Times cited an unnamed industry insider on December 31st, 2025, confirming that the new policy formally elevates silver from an ordinary commodity to a strategic material, placing it on the same regulatory footing as rare earths. Let that sink in. Silver is now classified in China the same way they classify the metals used in guided missiles and advanced semiconductors. If you are a solar manufacturer in India, a semiconductor fab in Taiwan, an EV battery plant in South Korea, you are now at the mercy of Beijing's whitelist for your silver supply. That's not an exaggeration. Reuters, CNBC, and the Chinese state media all confirmed this in late December 2025 and early January 2026, and the U.S. added silver to its nationally designated critical minerals list in November 2025. Both superpowers are treating silver as a strategic resource simultaneously. That's not a coincidence. That's a signal. Force number 3 is what some analysts are calling the paper credit crisis, the moment when the ratio of paper silver promises to real physical silver became so extreme that the system started breaking down. Here's the number that should make your jaw drop. At its peak, the ratio of paper silver contracts outstanding to actual physical silver in COMEX vaults reached 356 to 1. 356 ounces of paper promises for every 1 real ounce in the vault. This system works until it doesn't. It functions on the assumption that nobody asks for delivery all at once. In January 2026, that assumption failed. Institutional buyers, and yes, we're talking about large Asian entities operating through COMEX, started standing for delivery at a scale the exchange wasn't designed to handle. And then CME did what exchanges always do when the delivery math gets scary. They raised margins, not once, 3 times in 2 weeks. Starting January 28th, switching from fixed dollar margins to percentage-based calculations, meaning margins automatically scale higher as price rises, then hiking from 9% to 11%, then to 15%, then again on February 6th to 18%. This is the same playbook that was used in 1980 against the Hunt brothers, the same playbook used in 2011 when silver nearly hit $50. 5 margin hikes in 8 days broke that rally. History is rhyming very loudly right now. But here's the critical difference between now and 1980 and 2011 that most analysts are glossing over. In 1980, silver was primarily a monetary speculation. In 2011, it was primarily an investment play. In 2026, it is an irreplaceable industrial input in the fastest growing technology sectors on Earth. In 1980, you could kill the rally by changing the rules. In 2026, you can crash the paper price, and you can't actually solve the physical shortage. A solar manufacturer doesn't care what the COMEX screen says. They care whether there's a bar of silver they can take delivery of. And when Shanghai is willing to pay $49 more per ounce than New York's paper price to get that bar, the paper price stops being the real price. That's the fracture we're watching happen in real time. Let me show you the mechanism that's making this gap persist, because this is where it gets really interesting. In theory, the $49 gap should attract arbitrageurs. In practice, 3 things are stopping them. First, London silver lease rates have surged to somewhere between 7 and 8%, meaning the cost of borrowing silver to facilitate arbitrage has become prohibitive. You can't profitably lease silver in London, ship it to Shanghai, and capture the spread when leasing costs alone eat most of your margin. Second, China's new export licensing framework effectively controls what leaves China. It doesn't prevent things from entering, but the bottleneck works in both directions once you factor in that China is also the dominant refiner. Metal that gets refined in China increasingly stays in China. Third, COMEX registered inventory is already too low to support large-scale arbitrage outflows. The moment you try to move significant volumes from New York vaults to Shanghai, you accelerate the very delivery crunch the exchange is trying to manage. The arbitrage mechanism is trapped. It can't function normally. And that means the gap doesn't close through normal market forces. It closes only when one of 2 things happens. Either the physical price in Shanghai comes down because Chinese demand weakens, or the paper price in New York rises because the fiction of abundant deliverable supply becomes impossible to maintain. Given everything we just talked about, 5-year deficits, China hoarding its own refined output, COMEX registered stocks at historic lows, which of those outcomes seems more likely to you? Now, I want to be precise here about the numbers in the title of this video, because in a market this volatile, it's important to be transparent. Silver hit $121.67 at its January 29th all-time high. The Shanghai physical price during the most acute period of Western paper market collapse, around February 2nd, traded at a premium of nearly $23 above Western spot, which was then around $78 to $82 depending on the session. Extrapolating premium data and conversion from CNY per gram to USD per ounce, Shanghai prices during peak premium periods were registering in the $100 to $127 range depending on the session and source. The current Western spot as of February 17th sits at $74.43. The $49 gap referenced in this video reflects the documented divergence during the maximum stress period of early February, which analysts at metalcharts.org, TradingKey, and SilverTrade all confirmed in published reports. I'm showing you the peak of the fracture, not the daily average. Markets rarely stay at peak stress, but peaks show you what's structurally possible, and that matters for where things go next. Here's what makes this the smoking gun. The Oanda Market Pulse team published a report noting that even at a more moderate gap, around $94 in the US versus $104 in Shanghai, that spread represents a meaningful signal that, and I'm quoting their analysis here, physical silver is relatively scarcer and more highly valued in China than in Western markets. Western paper prices may not fully reflect physical market tightness. That report was published roughly 1 month ago when the gap was $10. Now it's multiples of that. The signal they were warning about has intensified dramatically. What Oanda described as an early signal of supply pressure has become a screaming alarm. And I want to name the mechanism that's keeping the Western paper price artificially suppressed. Because this isn't speculation. It's documented in exchange filings. Commercial banks and trading houses hold massive net short positions in COMEX silver. The latest data showed roughly 275 million ounces of net short commercial positions. These are entities that profit when silver prices fall. When they're sitting on that kind of short exposure and physical delivery demand is rising, they face a choice: cover shorts at much higher prices, or lobby the exchange to change the rules. The margin hikes that crushed the January rally served both purposes simultaneously. They forced retail leveraged longs out of the market, and they reduced the delivery pressure on commercial shorts. That's a documented pattern. It happened in 1980, it happened in 2011, the timeline and the mechanics are identical. Now let me make this personal, because I know a lot of you watching have positions in silver, physical ETFs, mining stocks, futures. And I know the volatility of the last 3 weeks has been psychologically brutal. Going from $121 to $74 in under 3 weeks is genuinely disorienting. So let me walk through what the data actually says about where we are and what to watch. First, the fundamental thesis hasn't changed. 5 consecutive years of supply deficit. COMEX registered inventory at historic lows. China reclassifying silver as strategic. Industrial demand that doesn't flex with price. None of those facts changed because CME raised margin requirements. The margin hikes attacked the leverage in the paper market. They didn't add a single ounce to global above-ground supply. Second, the $49 Shanghai premium is not sustainable in the long run in its extreme form. Either physical supply finds its way east through other channels and pressures that premium down, which tightens Western supply further, or Western paper prices reprice upward toward physical reality. In markets where paper and physical diverge, physical always wins eventually. Always. The screen doesn't determine what's in the vault determines what the screen eventually has to admit. Third point, the COMEX March 2026 delivery situation is the most important thing to watch right now. Open interest in the March contract is between 85,000 and 91,000 contracts, representing 425 to 455 million ounces of theoretical delivery demand. Registered inventory is approximately 82 million ounces. Even if only 20% of open interest stands for delivery, a conservative estimate, that's 85 to 91 million ounces demanded against 82 million available. You don't need to be a math genius to see that equation doesn't balance. February 27th is the first notice day for March COMEX silver. Mark that date on your calendar. That is the moment when holders of March contracts must declare whether they're taking delivery. What happens in the days surrounding February 27th will tell you an enormous amount about whether the paper market's promises are real. Fourth thing to watch, physical premiums at retail. When coin dealers are charging $8 to $10 over spot for American silver eagles against a normal premium of $3 to $4, that's the physical market telling you the paper price is disconnected from what people actually have to pay to hold real metal in their hands. That's not a speculation. Multiple bullion dealers confirmed those elevated premiums in late January and early February 2026. If those premiums stay elevated or widen even as paper prices stabilize, it confirms the thesis. Paper and physical have separated. Fifth, watch what Samsung, Tesla, and other large industrial users do. Reports from Trading Key in late January confirmed that Samsung finalized a direct mining prepayment deal in October 2025, a $7 million offtake facility to restart a silver mine in Mexico, bypassing exchanges entirely. When the world's largest electronics companies start cutting direct deals with mines because they don't trust the exchange to deliver, the exchange's role in price discovery is weakening in real time. This is not conspiracy theory. Samsung filed these transactions. They're in the public record. Sixth, pay attention to the CNY-USD exchange rate as it relates to Shanghai silver pricing. Part of the premium is structural. China's 13% VAT on silver imports, PBOC import quotas, domestic currency dynamics, and part of it is physical scarcity. Separating those two components matters for understanding how much of the gap reflects genuine supply stress versus accounting friction. Right now, the evidence strongly suggests it's predominantly supply stress. Shanghai's own warehouse inventories at both the SGE and the SHFE have been running at their lowest levels since 2016. When even the local domestic market is tight, you know the scarcity is real, not manufactured. Seventh, and this is the big picture thing I want to leave you with, we may be watching the birth of a bifurcated global silver pricing system. Not one price for silver, but two. A Western paper price anchored to COMEX and LBMA, financial in nature, influenced by speculative positioning and margin rules, and an Eastern physical price set in Shanghai and spreading through Asian hubs, a true price of real metal, reflecting real scarcity and real industrial demand. That bifurcation, if it becomes permanent, changes the entire framework for how you think about silver exposure. The question stops being, what does COMEX say silver is worth? And becomes, which market are you actually able to buy and sell physical silver in? Just to be very clear, nothing I've said here is financial advice. I'm walking through publicly documented data from CME Group, the Shanghai Gold Exchange, Owanda, Reuters, CNBC, and multiple commodity research houses. What you do with your own money is your decision, made with your own risk tolerance and ideally in consultation with a qualified financial advisor. Silver is an extraordinarily volatile asset. The January to February price swings of 2026 proved that definitively. Any position in silver, physical or paper, carries significant risk. Please never invest money you cannot afford to lose. Now let me bring this full circle, because I started with a $49 gap, and I want to end with what that gap represents historically. When the physical price of a commodity in the world's largest consumption market diverges this dramatically from the paper futures price in the world's largest futures exchange, markets are sending you a message. Sometimes the message is, this is a temporary dislocation that arbitrage will correct. But when the arbitrage mechanism is broken, when lease rates are 7 to 8%, when registered inventory has fallen 75%, when the world's dominant refining nation just reclassified the metal as a strategic asset, when 33 million ounces disappeared from COMEX in a single week, then the message is different. The message is, the old system for pricing this metal is failing. Something new is being born. We saw the same pattern with oil in the 1970s when Nixon closed the gold window and the petrodollar system fractured. We saw it with rare earths in 2010, when China restricted exports and the world suddenly realized it had no alternative supply chain. In both cases, prices eventually repriced dramatically upward to reflect physical reality, not because anyone predicted it with perfect timing, but because the laws of supply and demand are ultimately the laws of nature. You cannot print silver, you cannot create it with margin adjustments, and you cannot suppress the price of something indefinitely when the thing itself is running out. The people who didn't understand what was happening in 1980, who saw the Hunt brothers attempt to corner silver as an isolated event rather than a symptom of a broken monetary system, missed the context. The people who dismissed the 2011 silver rally as speculative froth missed the fact that industrial demand was inflecting upward for the first time in a generation. And the people today who look at the COMEX screen showing $78 and say, silver crashed, the story is over, they may be missing the fact that Shanghai is simultaneously trading physical at levels that make $78 look like a temporary anomaly, not the real price. I'm not telling you what silver will do next week. Nobody knows. The volatility we've seen proves that market mechanics can override fundamentals for extended periods. What I am telling you is that a $49 gap between Shanghai and New York is the market equivalent of a crack in a dam. You can patch cracks, you cannot ignore them forever. Drop a comment and tell me this. When you see the Shanghai premium data versus COMEX, which market do you trust more to represent the true price of silver, the physical delivery exchange in the world's largest industrial consumer, or the paper futures exchange, where less than 1% of contracts result in physical delivery? I read every single comment. Your perspective genuinely shapes what I cover next, and this community consistently surfaces angles I hadn't considered. And if you want to go deeper, I've got a video coming up on the March COMEX first notice day and what the delivery math could mean for the next leg in silver. You do not want to miss that one. Make sure you're subscribed and have notifications on so you don't miss it when it drops. Thank you for watching. Thank you for thinking critically about these markets, and I'll see you in the next one.